Why did the United States increase interest rates? Hello, and welcome to our video on the recent decision by the United States Federal Reserve to increase interest rates. In this video, we will explore the reasons behind this decision and examine the global impact of increasing interest rates. So, if you're someone who is interested in economics and wants to learn more about this topic, then keep watching. The United States Federal Reserve is responsible for setting monetary policy in the country. One of the tools it uses to manage the economy is by adjusting interest rates. On December 16, 2020, the Federal Reserve announced that it would be increasing its benchmark interest rate by a quarter point to a range of 0.25% to 0.50%. This was the first time the Fed had raised interest rates since 2018. The reasons behind the increase in interest rates. 1. Strong economic recovery. One of the primary reasons behind the Fed's decision to raise interest rates was the strong economic recovery in the United States. The country has been experiencing robust economic growth for several years now, with low unemployment rates and steady wage growth. The Fed was concerned that this strong growth could lead to inflation, which can be damaging to the economy in the long run. By increasing interest rates, the Fed hoped to slow down economic growth and prevent inflation from spiraling out of control. 2. Higher inflation expectations. Another reason behind the Fed's decision to raise interest rates was higher inflation expectations. Inflation has been relatively low in the United States for several years now, but some analysts have been concerned that this could change as the economy continues to recover. The Fed's decision to raise interest rates was intended to signal its commitment to keeping inflation under control and to prevent it from becoming a problem in the future. 3. Labor market tightening. The United States labor market has been tightening in recent years, with low unemployment rates and steady wage growth. The Fed was concerned that this tightening could lead to wage price inflation, where workers demand higher wages, leading to higher prices for goods and services. By raising interest rates, the Fed aimed to slow down the labor market tightening and prevent wage price inflation from becoming a problem. 4. International economic conditions. Finally, the Fed's decision to raise interest rates was also influenced by international economic conditions. The global economy has been experiencing slow growth in recent years, with many countries struggling to recover from the 2008 financial crisis. By raising interest rates, the Federal Reserve hoped to stabilize the U.S. economy and prevent any potential spillover effects from weaker economies abroad. The global impact of increasing interest rates. 1. Stronger US dollar. One of the consequences of the Fed's decision to raise interest rates was a stronger US dollar. When interest rates rise in the United States, foreign investors are attracted to its higher rates, leading to an increase in demand for US dollars. This higher demand leads to an appreciation of the US dollar against other currencies, making US exports more expensive and reducing demand for them. 2. Increased volatility in emerging markets. Another impact of increasing interest rates was increased volatility in emerging markets. Emerging market economies are typically more vulnerable to changes in global financial conditions. and higher US interest rates can cause capital to flow out of these countries and back to the United States, leading to slower growth and higher unemployment rates. This can create social and political instability, which can impact the global economy. 2. Impact on global debt. Finally, the Fed's decision to raise interest rates could also have an impact on global debt. Many countries have borrowed heavily in US dollars, and a stronger US dollar can make it more difficult for these countries to repay their debts. This, in turn, can lead to financial stress and instability, potentially impacting the global economy. Conclusion. In conclusion, the Federal Reserve's decision to increase interest rates was driven by several factors, including a strong economic recovery, higher inflation expectations, labor market tightening, and international economic conditions. While the increase in interest rates may have a short-term impact on the U.S. economy, the global impact is likely to be more significant, with a stronger US dollar, increased volatility in emerging markets, and potential impacts on global debt. As always, we will continue to monitor this situation and keep you up to date with the latest developments. Thank you for watching.